All right, let's talk about a major shift in GST policy. If you're in the tobacco or pan masala industry, you absolutely need to know this. The government has rolled out a completely new way to calculate tax value, and honestly, it turns everything you thought you knew on its head.
So let's just jump right into the big question. Imagine this. You make a sale for 60,000 rupees, but then you're told you have to pay tax on a value of over 71,000. How is that even possible? It sounds totally wrong, right? But believe me, it's not. This is the new reality under a very specific GST rule, and we're about to break down exactly how it works and, more importantly, what you need to do about it.
You know, the key to solving this whole puzzle is a new concept called RSP-Based valuation. This is the government's new method, and it really does change the game for how tax is calculated on certain goods. It's a fundamental shift away from the normal way of doing things, so let's get into what it actually means.
And just to be super clear, this isn't something that's coming in the future. It's already here. The official notifications came out at the end of December 2025, and this new rule kicked in on February 1st, 2026. So if this is your line of business, these changes are affecting your transactions right now.
So, what is this RSP-based valuation? Well, the idea itself is pretty simple, but the impact is massive. The government is basically saying, look, we don't care what you actually sell the product for. From now on, your GST is going to be calculated based on the retail sale price, the RSP that's printed right there on the package. If you can get your head around that one point, everything else will start to make sense.
Okay, so who needs to be paying close attention? The government has been really specific, targeting products under these HSN codes. We're talking about pan masala, cigarettes, cigars, all that stuff. Basically, if you deal in any of these items, this new valuation method is for you.
All right, that's enough of the theory. Let's see how this whole thing actually works in the real world. We're going to walk through a very practical, step-by-step example. You'll see exactly how to calculate the tax and how to prepare your invoice under this new system.
So it all boils down to this one official formula. Your tax amount is the total RSP multiplied by the GST rate and then divided by 100 plus that GST rate. Now, what's the most important thing you notice here? Your actual selling price. It's nowhere in this equation. That's the key. Now let's put some numbers to it.
Okay, step one is the legal calculation. Let's say you're selling 1,000 packs, and the RSP printed on each one is 100 rupees. That gives you a total RSP of 1 lakh. Now, we plug that into our formula with a 40% IGST rate. The tax comes out to 28,571 rupees. Now, if you subtract that tax from the total RSP, you get this brand new number, the deemed taxable value of 71,428. Just remember that number.
So that was the tax world. Now let's switch over to your actual business deal. You might sell those same goods to a distributor for, say, 80,000 rupees, maybe after giving a 20,000 rupee discount. So the money that actually hits your bank account, your net sale value, is only 60,000. That's your real revenue. And right here, this is the heart of the confusion. On one hand, you've got this deemed taxable value of over 71,000 rupees, a number that exists only for the purpose of calculating tax. And on the other hand, you have your actual net sale value of 60,000. These are two completely different numbers for two different purposes, and you have to get them both right.
So how do you actually create the invoice? Well, it's basically a mix of these two worlds. You start with your real net sale value, the 60,000. Then you add the tax that you calculated from the RSP formula, that 28,571. Add them together, and that becomes your total invoice value. That's what your customer pays.
Okay, so you've done the math right. That's great. But the next step is just as critical, reporting it correctly. Because if you get this wrong on your e-invoices or your GSTR1 filings, you could be in for some serious compliance headaches. So let's look at exactly how to fill out those forms.
The government guidance here is actually crystal clear. When you're filing, in the taxable value field, you put your net sale value. That's the 60,000 from our example. In the tax amount field, you have to put the tax you calculated using the RSP formula, the 28,571. The total invoice value field should then just be the sum of those two.
Now listen up, because this is probably the most important part of the whole process. When you enter 60,000 as your taxable value, the GST portal is probably going to auto-calculate the tax for you. It'll show the wrong amount. You absolutely must manually override the system and enter the correct tax amount that you calculated from the RSP formula. Do not, I repeat, do not trust the system's auto-calculation.
Phew, okay. We've covered a lot of ground, from the big idea to the nitty-gritty of the calculation and reporting. So let's just wrap it all up with a quick and simple compliance checklist, just to make sure you've got everything straight.
And don't just take it from me. This quote from the official advisory says it all. The responsibility is 100% on you, the taxpayer. It says you must self-assess, self-calculate, and correctly furnish all those values. The bottom line is, the government is making it very clear that it's your job to get this right.
So let's recap the 5 most important things to remember. Number 1, your valuation is now tied to the printed RSP, not your actual sale price. 2, you have to use that specific government formula to figure out the tax. 3, in your filings, the taxable value is your net sale value. 4, the tax amount is your RSP-based calculation. And number 5, the golden rule, always, always, always double-check and manually correct what the system tells you before you hit submit.
And that brings us to one last bigger question. You see, this whole RSP-based valuation thing is a major policy experiment. For now, it's just for tobacco and pan masala, what they often call sin goods, where the government wants to keep a tighter grip on tax collection. But you have to wonder, could this be a sign of what's to come? Could we see this model expand to other products that have a fixed MRP? It's definitely a question every business owner should be thinking about.